and welcome to another podcast where I have invited Cameron Murray to come back and have a chat with us, really just to discuss what's going to happen next year. There's been a lot of fear about rising interest rates, about what's going to happen with the housing market, where the economy is going. Is there going to be a recession? Obviously, there's a lot of reports out there, very negative reports about prices in the property market, median prices continuing to have significant falls over the year. And I think that myself and Cameron and perhaps Louis Christopher also are a few that stand a little bit contrarian to what the mainstream is putting out. So welcome, Cam. I'm so glad you were able to join.
Yeah, thanks for having me again, Catherine.
Yeah, you're welcome. I'm sorry, I got the time wrong earlier. So this is a late interview from when we originally arranged. But so thank you for jumping on. Do you just want to just give me kind of like a little bit of an update as to what you're working on now? Because you've got your Substack, obviously, which I'll put the link in the show notes so that people can, subscribe to that. But that's a lot of independent, it really is what it says, which is independent, fresh economic thought. So you've always got new ideas and new things that you're working on. I'm interested to know what's going on for you at the moment.
So the Substack is one thing where I'm essentially putting on my public face, and that serves a couple of roles. One is just venting my frustration with things that are circulating in the media, things that seem detached from the data and the reality. And another use of that is as a first draft of my ideas to help me communicate subtle economic concepts to a broad audience. So I draft up my attempted explanation, my analogy, and see what sort of response I get, because the big project I have at the moment is a book about housing markets that I hope to have out for Christmas next year. And that's all about the big theme is that you've been lied to about housing markets. And the reason that we are constantly being lied to is that there is a fundamental financial conflict at the heart of property. And that zero-sum conflict is that property owners want prices to be higher and rents to be higher, and non-owners want the prices to be lower and the rents to be lower. And so from a policy perspective, we're always trying to avoid this harsh financial truth, and hence we start telling ourselves little stories about, there's this magical supply side up zone and prices will fall, or there's some other kind of magical intervention we can do where we're all better off. And that's just not the case.
And that's been the policy response, is always trying to balance those two narratives, isn't it? Because policy response regarding affordability is always, we'll just increase the supply, and they don't want to do or we'll give first home buyer grants out, which is kind of will help you get onto the ladder, but will also help the vendors at the same time.
So this is the heart of the conflict. This is the political reality that we never deal with, and hence we end up telling ourselves stories, and we just go around in circles with a lot of nonsense, and you end up also, this sort of framework helps you understand why when prices are going up, people complain. When prices are going down, people complain. When rents are going up, people complain. When rents are going down, people complain. When rents go down, we say, we're not attracting enough investors into the market or something, right? It's because there's these opposite financial interests in all of these situations. So there's always someone to be upset, no matter what's happening, at what stage of the cycle we're at. And so hopefully this book can arm people with a bit of a higher level view of the market, especially put some things in context. We're always, and I think this is your bread and butter, Catherine, but people are always looking for some supply and demand explanation. Why is it that prices are falling right now? Why is it prices are rising right now? I'm looking for some kind of once-off explanation, where sometimes the explanation is the market goes in cycles and this is where we're at. That's the answer to why this is happening right now, and why it didn't happen 5 years ago when the same underlying supply and demand conditions were there. It's just there's a financial cycle as well. So that's all part of the story that I hope to weave through into this book and have out at the end of next year.
Yeah, that's interesting, because how many times have we heard politicians say, it was Tony Abbott that said, oh, we just want prices to go up a little bit, not too much, that they just keep going up. Or I've never had anybody complain, stop me in the street. That was John Howard. I've never had anybody stop me in the street and complain that the property prices are going up.
Yeah, and people just don't really have a good handle on yields, returns, incomes, just the basic landscape of the economy. I remember having a conversation with John Alexander, who was a Liberal MP for a while. He was very worried about the housing market. And I said, well, how much do you want property prices to fall by? And he said, I don't want prices to go down. Okay. I said, how much do you want them to go up by? He goes, oh, is 5% a year sounds all right. I'm like, do you know how much that is? Like, can I just get a calculator out and tell you what 5% per year compounded is for the next 15 years? Because, it might happen if incomes rise by more than that. But what you're really saying is, I want I want the up part of a cycle with no crash. Just because we'd come off 2 years of 10% growth, all of a sudden 5% looks good. Well, and they sort of try and lock that in forever. This is the stable thing we want for the next 2 decades, whereas there's just no evidence that's ever happened historically.
Yeah, I mean, there's no getting away from the fact that the policies in this country are bent towards property speculation. I mean, that's how the policy is designed. It's written into policy that they want people to buy properties and to use the wealth from the land price inflation to assist them in their retirement. I mean, it's a hedge against high income taxes, that you negatively gear, and so it assists your tax position through purchasing investment properties. I mean, that is just the way that the policies in the country work. And to change that, obviously, is something that we tackle at Prosper Australia all the time, because it's not, I think that you probably would agree that it's actually not difficult to create an affordable housing market. It is something that is easy to do policy-wise. But I mean, to actually transition to policies that would allow that is the difficulty in a country that has that is bent towards speculation as we have it at the moment. But I don't see that. I think that to have an affordable housing market is something that is possible and easy to achieve through changes in policy, particularly changes in tax policy.
Yeah, so that's the thing. I think technically straightforward, politically very difficult. And when we have politicians owning 2.7 residential properties on average, so we're talking nearly $3 million worth of residential property, and 66% of households being homeowners who want prices to go up, not down, and $10 trillion worth of residential property value, a 30% decline in prices is $3 trillion wiped off the balance sheets of the most politically important households in the country. So there's the conflict. And I actually tweeted about a month ago, I said the 2022 policy panic has been about high house prices. The 2023 policy panic will be about low house prices or falling house prices. We'll just change on a dime and no one will even notice. We'll just start complaining about the opposite thing, as if there's no inconsistency. So a very strange situation.
So I'm interested in something else that you said about that book, which is regarding that it moves in cycles. And it's the one component that people just don't seem to look at, which is what's happening to the cycle. They look at all the fundamentals and what can we do and how can we tinker at the edges of housing policy to get us through this situation. But there is obviously a cyclical factor. And I know that you have done research on the 18-year cycle, which is what we talk about at Cycles, Trends and Forecasts, and now at Cycle Investor, which is where this video will go out to, the subscribers will go out to. But so I'm interested in your opinion on that. What's your kind of analysis in terms of the cyclical analysis?
Yeah, so that's been a bit of a pet topic of mine recently. And so let me just give you some background. In in May 2020, I went on the Nucleus Wealth podcast and I argued that it's more likely that property prices rise 20% than fall 20% in the next 18 months. And this is just when COVID had kicked off and everyone was panicking about, unemployment, falling prices. Banks were doing these stress tests. And I just said, you're missing the cycle. We've just had 3 years of a market correction from 2017 to the beginning of 2020. And prices had fallen, yields had risen, the interest rate had already dropped in those years. If you recall, the central bank was already dropping interest rates. And so I just said, when have we ever had a cyclical downturn and at the bottom of that downturn had a crash? It was never there in history. And when you're getting over 4% yield and borrowing money at 2%, I just don't see who's going to panic sell when there's free money on the table. So that was then, and this is now. And so prices nationally have risen, very much focused on regional areas, less so in Sydney and Melbourne. If you look, I live in Brisbane. Brisbane prices hadn't really done anything for a decade, and they hadn't really adjusted to this lower interest rate environment and the higher incomes, and so they exploded upwards. And so now we're at this point where interest rates are rising, rents are also rising, and prices are falling in most cities. So we're having another adjustment period now, another part of the cycle. So we've got gross yields, for example, for apartments have increased from 3.8% to 4.4%, according to SQM's metrics. So that's 16% increase in relative terms. And so although interest rates are rising, it's pretty normal to borrow money at 5.5% and get a 4.4% gross rental yield on apartments. That's kind of what it was in the early 2000s. And then prices kept rising for 5 years. So I'm just not sure that we have seen enough interest rate rise or enough, the metric I use is the interest rate divided by the gross yield, the mortgage interest rate. We just haven't seen that blow out enough yet to have a big correction. So it's possible that we'll have this 10 to 15% correction, more in some regional areas, but that plenty of other parts of the market actually grow a little in the next couple of years. These high yield apartments, for example, there's plenty of investors with profits from the last couple of years who are looking to park that money, get their negative gearing, park it for the long term. So yeah, I actually tweeted recently, I predicted on no Australian recession in 2023. And that obviously got people talking because there's a big conversation about this imminent recession in 2023. And I just don't see the ingredients for that. I see too much anticipation. We get recessions when everyone's given up that a recession's coming, right? We get that panic.
Absolutely.
But what we have now is people anticipating that and holding out and smoothing out investment decisions into next year and the year after because of inflation, etc. So I just see there's just a queue of investments coming along. And so, yeah, we're at an interesting time. I would liken it more to, if you recall the 2003-4 period, in Sydney, prices fell more than 10%, but prices elsewhere boomed.
Yeah.
And I know a lot of people called that
at that point between 2003, 2004, but it was kind of reasonable to have a pullback at that time, sort of considering what had happened previously.
Yeah. And a lot of people thought this is the crash, everyone thought it much too early, and it was still another 4 years really. And so I think that maybe that's a similar pattern to what we're having now. Maybe it's slightly different, more like the end of the 70s because of the inflation and whatnot. Maybe that cycle's more closely related. But it's just always important to keep that in mind, that Sydney prices did fall more than 10% in 2003 and 4, and there wasn't a crash. And so it's not unreasonable that the regional areas that recently boomed have a 10 or 15% fallback. Sydney prices maybe stabilize, and we get another final show in this cycle before anything major happens in terms of the macroeconomy.
I think there's a few things there that you've spoken about which are worth kind of highlighting.
Mm-hmm.
And one is that you're saying, and I've said this to my subscribers as well, is that when you get a crash, it's normally on the back of rampant speculation that's rushing through the economy or rushing through the property market. So we saw that in 2007, for example, before the GFC, and that pullback then in property prices. And then the property market roared into 2017, and then there was a pullback. And okay, the Royal Commission was happening at the same time, and there was a depressive feel, and then of course the election went and we had this push up into 2019, a bit of a pullback at the beginning in 2020 when COVID hit, but then just roared, the market roared until a peak in 2022. And then obviously you cannot have that type of inflation that was produced at that time or accelerated at that time from the stimulus and from this great population migration to different areas of the country that just weren't set up to absorb that supply. And so again, it's natural to have this pullback. But what's happening right now with buyers, and I have this occur to me all the time, because obviously I'm in the business where I'm talking to buyers, and they're calling me up and they're saying, Catherine, we've been approved for say 550,000, but we only want to spend 500,000. Everyone's being cautious because they're planning ahead, that they're expecting further interest rate rises. And so there is a little bit of a shift going on in the market where you're seeing a few people that want to offload their properties because of that, and because they're going to change onto variable rates. I've seen that occur, and I know people are planning on doing that. But the only time you're going to get a real crash in the housing market, of course, is when you get a flood of supply. And we just have not seen that either. And with Sydney's market coming back, down that 10%, Sydney obviously is a more volatile market. So you're going to see more of a price drop when the demand goes out of that market. And then obviously when demand goes into the market, particularly from overseas migration, you're going to see the prices pump up. What the forecasters have been saying is not that we're going to get a 10%, to 7, well, it's not a 10%, a kind of 15 to 20, 25 to 30% fall from some people in Sydney. They're saying that that's going to be the national median price fall. And that type of fall has not happened for decades. You'd need to go back, I think, to the 1930s Great Depression to find that kind of fall in the national median.
Yeah, well, and think about how plausible this is in terms of the asset, the property asset as a substitute for other asset investment classes. What you're sort of saying is that the prices are going to fall. Something that already yields over 4% is going to fall by a third. So it's now going to yield 6%. And people are not going to want to buy a 6% yielding house in a reasonable suburb or a good apartment. I think they will. When was the last time that the price reflected a 6% yield on average in the capital cities? It's never fallen that low relative to rents. So I just can't see that happening now, especially when I think the market's already expecting this interest rate cycle to have peaked. So that's the other thing to keep in mind. If markets do anticipate what's coming to a degree. So if we think the market cycle's peaked, people will be a lot more comfortable borrowing at 5.5%, knowing that maybe it'll go to 6, but that's about it, than borrowing at 5.5%, thinking it's going to 9, like it did just before the financial crisis in the 2000s. So that's what makes me think that, I just can't see a large crash from now. The other thing that's different in this cycle is prices increase so quickly that very, very few buyers bought at these astronomical prices, right? So if a price falls 10%, if prices increase 10% in 1 year, that's only 1 year's worth of buyers that actually paid above what the market's worth, right? And I know it was increasing even faster than that in a lot of areas. So a correction of 10 or 15%, you might go, oh, everyone's going to be underwater. Well, that's only the buyers from September last year till December this year are underwater, and that's a very, very few. And I think most of them also had that built-in caution, like, we know this is not going to last forever. We know it's really risky. We're buying at high prices. So there's some kind of buffer there. And they've also paid 2% on their mortgage for 12 months. So that's should have helped them get a bit of a buffer. And as you said, a lot of buyers have built that in to their calculation. So I think that's just another slightly different thing. A price fall of 15%, say, in certain areas, is just it's a paper effect for everyone. But in terms of tipping people over into negative equity, I think it's going to have a much smaller effect than if that 15%, than if the price rise happened slowly. And we had the last 3 years of buyers, for example, paying above the current values. So I think, fast up and down, not many people miss out. It was a bit of froth, but if it was slower like this and then fell off, you'd have a huge chunk of people now in negative equity who weren't really bargaining on it and weren't really bargaining on the higher prices. So I'm not, I guess what I'm trying to say is I'm not too worried about a collective panic or a wave of selling, because there are buyers still floating around the market. And I don't think there's just that many sellers who would be sucked into panicking at the moment, especially when incomes are also rising, rents are rising.
Yeah.
Rents are the incomes of landlords, right? So they're happy.
I mean, it's the factor that people don't take into account. But I just wanted to talk a little bit, I just wanted to mention regarding the medium price falls, how much the medium hides what's actually going on the ground. So the medium obviously is just a middle number of a bunch of sales, a bunch of house sales, a bunch of apartment sales, or a bunch of the entire sales, depending on how you put the data together. But so we saw some big discounting from the top end, which probably would have been a drop more than your 10% or whatever, Sydney. So anybody that was selling at the upper end that had to sell during that period had to make big discounts in order to sell. It doesn't mean that they were underwater. Otherwise, there might have been a proportion that decided to sell a year later, from when they purchased. But in terms of the regional areas, I mean, I've been doing a lot of purchasing for clients in regional suburbs, and there are properties that have increased 100,000 through what people purchased for last year and what they're selling for this year, where there hasn't really been any particular fall in the market because they're at a lower price point. Of course, in an interest rate sensitive environment, people are being pulled to the markets, pulled out from the inner suburbs to the markets, which are a little bit more affordable in price. So that's been occurring a lot. But I wanted to talk about, because we had a quick discussion on the phone last night, and one of my things that I really feel is missed in general analysis is that people just look at the interest rate factor alone. They're saying, okay, so lending rates are rising. What impact is that going to have on the property market, without necessarily taking other things into account? I mean, SQM are sort of exempt from this because they certainly do the analysis, and therefore that's why they're so accurate. But a lot of the other data agencies are really just focusing on the lending rate and thinking that's going to have an impact. But we were discussing household incomes. Just have a chat about that.
So I'm totally with you. So I'm a big proponent that interest rates matter in terms of the underlying value, but I think where I differ from a lot of that talk is that interest rates matter for the sort of equilibrium value, but we never sit at the equilibrium value, right? The market goes below and above in cycles over time. So yes, it's a little bit like the interest rate's the tide, but there's also the swell on top of the tide as well, right? So you need to know if you're going through the storm and you're up on a peak or down in a trough of the wave. So that's where I differ. And I think, one of the factors we're missing at the moment is that household incomes are rising. And so if you have what I call my rough and ready model of the housing market, where rents are effectively proportional to household income and prices are essentially the capitalized value at the interest rate of the rent. If you have that in mind, then you need to also think about, well, household incomes are rising. Now, I guess my view is a very macroeconomic view. A lot of housing analysts sort of have this partial microeconomic view and go, oh, rents are rising. That means that's bad for household incomes and people will spend less. But the macroeconomic view says, hang on a minute, rents are the landlord's income. They're part of the macroeconomy and they get to spend as well. And so you can't just sort of pick half or a small fraction of the household income and say that's what's happening. And so one example there is we look at wage growth. And so if you look at the wage price index, for example, it went up 3.1% in the last 12 months to September, I believe. And so there's a lot of talk, oh, people's incomes aren't keeping up with inflation. But wages are only 40% of household incomes across the economy. The rest are mixed incomes, so self-employed people, and their incomes went up 13.5%. And then there's business profits, and of course their incomes to the owners of these businesses, and they went up nearly 30%, 29 point something percent. And then of course the total wages paid actually went up 7% because people are working better jobs and more people per household working because the unemployment rates come down. So household incomes, I think are, I think there's a bit of a misleading story in the press about it, that everyone's being squeezed by inflation, that we're being squeezed by high rents. But I think the actual story is that not only did we get all the COVID stimulus, we got $20,000 out of our super, plus businesses didn't pay for wages for a year with all that stimulus. So a lot of the story is, the wage index for the same job isn't really increasing, but through all the other channels of increasing income, through getting higher paid jobs, the changing composition of jobs, from more people working, from the self-employed earning more money, and the profit share and rent share for landlords and business owners, that's really boosting incomes. And that's why people can pay higher rents. So there's this story we get on rents that rents are going up because there's not enough supply. But actually what we've seen is the occupancy rate falls. So we're at a record low number of people per dwelling. People have spread out to the regions and filled up all the empty houses. They've got out of their group houses. We had record first home buying. So they moved out from home or share houses onto their own. So we had this record sort of decline in occupancy. So sort of an increase in dwellings per person in terms of occupied dwellings. So at the same time that's happened, we've had an increase in rent. And so that the only thing that can cause that in most areas is that people are earning more money. And so that's just another reason that I think it's very hard to see a big collapse in prices when the evidence in the rental market is most households are doing pretty well in terms of income. They're spending up to move to better locations, and these higher rents also make buying, the transition to buying more attractive as well, right? So you can now substitute a bigger mortgage for this higher rent. So these are all sort of elements that I think are in place. And the household income one is definitely one that not so many people have acknowledged that's happening this year.
And the other factor, of course, is that the government's got this home build promise, where they're saying, okay, we're going to build a million homes in 5 years, million well-located homes in 5 years. Against kind of a backdrop, really, of the development industry just over the last few years has been decimated. The small developers I'm talking about, because, we had the 2018 through 2018, they found it difficult to get finance because of the Royal Commission into the banking sector. And then we were just getting out of that. And then because COVID hit and you've got the supply issues and everything that kind of translated from that. So the small developers have really kind of struggled. There's not been a huge amount of building activity. We're hearing about a lot of insolvencies from the big builders. So my wondering with that is how long before the government has to put something in place and say, okay, well, we need to have some kind of stimulus for the building industry and the construction industry, which are usually always the first industries to receive anything from the government in terms of incentives and stimulus. Do you think that there might be a chance of something like that happening?
Well, I think we're still washing through from the home builder subsidies from COVID. I think a lot of those projects are still being constructed today.
Oh, and not finished because
Yeah,
of
unfinished. So I think we've had record unfinished dwellings throughout the year. So 2023 will be a bit of a year of finishing projects. And I think it'll be a bit of a year of shifting from detached dwellings that really got the stimulus during COVID and the change in preferences for people moving to the regions and whatnot. I think 2023 will see a bit of a shift back to apartments, partly because of this higher yield, partly because of the changing distribution of incomes, as I was talking about, the extra profit shares. These people are going to have to park those profits somewhere, and an off the plan apartment gets you a lot of negative gearing benefits if that's what you want. So I do see that sort of shift, but I still think the pipeline for construction is quite full. It's still very hard to get a builder committed. So I know my builder mate said, I don't even talk to new clients anymore because I'm sorted for the whole of next year, and people are paying what they're prepared to pay, what it costs. And so I think 2023 will be the return of orderly construction, I might call it. If we think of the last 18 months as chaos and panic and delayed construction times, I think 2023 will be the return to orderliness as a lot of these stimulus projects get finished and some of the bigger developers schedule in some of their apartments and whatnot in the capital cities again. So I don't think any stimulus is going to be coming for a while yet. I think the market's got the construction industry sorted for 2023.
I agree with what you're saying. The thing is when that initial stimulus came through, it was for the benefit of the housing developers on the outskirts of the city that were building in the new estates, because of that it was, the policy was written up was that you had to purchase and have something that was going to commence construction within 3 months, I think it was. So the land estates, the big land estates, there was huge land price inflation areas because they just obviously reap the gain of this influx of people buying there. And as we know, like a lot of those projects, a lot of those homes still haven't been completed. So the argument really is how on earth are we going to fulfill? I mean, it's going to be a challenge if you're saying, okay, on top of all of that work that has not been done and is contracted out, how are we then going to provide the market with another influx of the well-located properties, which we made as an election promise?
I see what you're saying.
Shortages will be assisted a little bit with immigration coming in, but there is a challenge there, I think, for the industry in order to, against what's going on, against the environment currently.
Look, in terms of that million houses policy announcement, I found that very, very, how do I explain it? Good politics, good big number, good announcement, no substance. So I think they're just going to claim credit for the next 1 million dwellings that get built over the next decade, right? There's going to be essentially no policy change. It's just going to be, we're going to take credit for the next million houses. It's a little bit like, I think, who was it who said, that we're going to create 1 million jobs, and they just watched the labor force go up by 1 million and then go, we made 1 million jobs with no actual policy change. So I always think of the 2008 to 18 period. So we had a national body called the Housing Supply Council, and it was formed because everyone worried that we need more houses, right? It's a perennial problem. And they made these decade-long forecasts of how many people we expect in the next decade, and under this scenario, how many dwellings do we need? And they had 3 forecasts: their low, medium, and high population growth, and how many dwellings would need for each. And then they basically panicked and said, how are we going to do this? What happened in reality is they did nothing, no policy change. And what happened is we had the lowest population growth forecast despite such high population growth in that decade. They obviously wanted to put even more ambitious population growth targets. So we had the lowest population growth, but the number of dwellings we built actually exceeded their highest population growth dwelling requirement in that scenario. So we absolutely smashed the amount of dwelling construction that they had forecast that we could plausibly need, that they were panicked about, that we could possibly build, just because, you know, the market does its thing, right? People come up to buy a house, some developer's going to build it for them, right? And so I do think that maybe we're in a bit of a period like that again, where we're sort of so focused that it's a supply story and how are we going to do this, that we forget that it's not really a supply story right now, and that there'll be plenty of houses built if people show up and buy them. And we know also on the supply side that this sudden drop we had in household size of fewer people per dwelling for COVID, that can easily reverse when people want to relocate into the cities again. And so therefore, you know, a 1%, so we had a bit over 1% drop in household size. If we do that again and have a 1% increase, that's 100,000 dwellings, right? That will suddenly be empty. That existing dwellings that will, you know, be on the rental market or the sale market. And so we'll find that there's plenty around. I always say, in Ireland in the 2000s boom, everyone panicked. There's not enough houses. There's not enough houses. There's always not enough houses. And then all of a sudden, there's more houses than you can poke a stick at. No one wants them. So I think, I'm less worried about the physical change in the housing stock and more about the cyclical nature of who wants to buy and sell at the same time.
Yeah, and because that story, because they started destroying the new estates that they constructed, you know, when they really hit bad in 2008.
Yeah, that's right. They were demolishing their half-finished buildings because, you know, trying to sell them just further depress the prices and make the situation worse.
Oh, it was the same story in the US. You know, they were saying in the lead up, it's a supply problem. There's a supply problem. In reality, like when you work on the ground, the supply problem really is just in the well-facilitated areas and the established areas where people want to live. And there, the supply demand dynamics in the short term really do affect the market. The problem is you know, when you've got swathes of land and you're building new estates, which is you know, arguably for those people that live there, but it's poor quality housing in areas which aren't necessarily an easy commute to the facilities that you need.
Yeah.
There was a study that was done, oh gosh, it was a while back now, but it was a health study that was done on people that lived in the outer suburbs, showing how their health was really diminished by the fact of the long commutes and the lack of facilities and the lack of medical facilities and the not easy access to high-paying jobs. I mean, some of that might have been mitigated a little bit now with the with the work from home and everything that's happening. You know, that is obviously easier now for you know, that you can work from home for a period of time. So maybe, you know, that's assisted to some extent. But yeah, I think that's the argument really from a real estate point of view, is that there's, and then of course the other one is the amount of homes that are really vacant or that aren't utilized as they should be. And that is a policy problem. It's not a supply problem. It's a policy problem of how do we have a market that actually provides properties that are utilized rather than has an incentive to hold properties for gain. You know?
So I think all of that points to the heart of the issue, and as I said, the issue in my book is that property owners want the price to go up. There's no obligation for them to do anything. They have the option to build a dwelling. They have the option to develop today. They have the option to wait around another decade for prices to rise. And so, you know, these are almost fundamental features of the housing system that we've had for hundreds of years, right? I like to quote from Charles Darwin, you know, the biologist, the evolution of the species, the famous Charles Darwin in 1832, when he sailed into Sydney on the Beagle, the ship the Beagle, for the first time. The first paragraph of his diary when he arrives in Australia, I have to find it so I can quote it. Let me find it here. He says, I'll quote, "The number of large houses just finished and others building is truly surprising. Nevertheless, everyone complains of the high rents and difficulty in procuring a house. So it's way back in 1832. It's not like there was any sort of physical shortage. It was just the nature of, well, property owners don't want to give away their property for free, right? And so there's a big advantage to being first in and getting your plot on the land titles register, and then getting the maximum rent you can from everybody else. So yeah, I think it's just a sort of structural issue, and I've been talking about that a lot recently, and proposing that Australia, if we are concerned about access to housing for the poorest or the lowest 20%, we should really have a public option to or a public home ownership option where people can just buy from the government a discounted property, just like we have a national option or a public option for healthcare, a public option for schools. I think that would be a good way to address all these issues we have without actually tackling head on this financial conflict between property owners and renters, and manipulating the price in the private markets and upsetting 2/3 of households by doing it. So that's where my thinking is now. But yeah, so the other element of supply is it's people use the word supply a lot, and I'm, it's another bugbear of mine. So I'm sorry to your audience. I'm going to take the liberty, but we use the word supply to mean two different things. One is the stock of physical dwellings, and the other is the number of property owners who want to sell at the same time, and they're different. Right? So with the same stock of dwellings, you can have a lot of people trying to sell all at once and a big crash, or no one willing to sell because it's a good investment. The price is going up. Why would I sell a good investment? And I think, it's trivial that supply, when you mean participation in the market, willingness to sell, affects price. Of course it does. That's exactly how prices are set. There's no controversy. But the stock is a different thing. And I think that's important to keep in mind, that you can have boom and bust cycles with today the biggest, best, largest, most houses per capita that we've ever had in history. And you can have boom and bust cycles with half as many dwellings per capita that we had 40 years ago when it was 4.5 people per dwelling on average. So you get the same patterns. The physical stock is really not the key element here.
Yeah, I mean, there's all sorts of things that can be done in terms of that supply question that you're talking about, the policy of the government, selling houses directly to the public. It reminds me of what they do in Germany. And I think I'm correct that they still do this, but the government will buy, on the outskirts, land around just above agricultural value. So there's no huge uplift from any rezoning uplift, and then sell it direct to the public, who then do the subdivision and employ a builder to go and build on the land. So they're actually buying land that's affordable, rather than the way that we have it here, where you've got the big developers that control the land supply because they've gone and bought the bulk of land on options. Therefore, then of course drip feed it onto the market in the stage releases as they release that land supplier as they prepare their development projects. So yeah, I mean, there's a lot of policies that could be looked at. Of course, they're not looked at in this country because of the fundamental problem that you're talking about in that book, which is do we actually want land prices to go backwards under a structure of the economy that we've got currently? The land prices to go backwards would cause a financial crisis if they were to drop far enough. And what owners would do if their land prices looked like they were about to crash, or that they were plummeting through the floor, then there would be that offload of stock and that potential flood of stock onto the market that would trigger that point of where you're saying, okay, it's you've got your crash scenario there, but you've also got a financial crisis that's going against it, because land is used as collateral, for business loan or residential mortgages.
That's the tension there. The property market's intertwined with the financial market, as we know from the cycles and crashes of history.
Yeah. So, I mean, talking about cycles, I'm interested in, we haven't really had a lot of conversations on the cycle and the 18-year cycle, and I know that you've done your work on it. I mean, what's your opinion in terms of this one playing out as forecast? Have you thought about it? Because I know you've made some comments about it. You've made some comments on Twitter about it at times. You've never written anything on it.
No, not exactly. I guess I take the 18-year cycle as a bit of a rule of thumb. Maybe it's 17 years, maybe it's 20, but yeah, there's a long cycle. And I definitely buy in that there's a long cycle, and that's why I'm really hesitant about this 2023 crash that we're all talking about. So I've been in two minds this year. Firstly, did the COVID stimulus and sharpness of the rise bring forward in time the cycle? Did we take this curve and then accelerate it so it's more, and have we brought the crash forward? Or have we just increased in amplitude this upswing that we were going to get right now with this extra stimulus, but fundamentally it's not a major correction that we'll be in for. And I'm erring more towards it's too early, and that we didn't accelerate the cycle with all the stimulus and the very low rates. It just feels to me too soon for the next big crash. Because if you think about the share market, we've already had a huge correction this year, but no panic. Right? The property market's had a pretty decent correction already, but no panic. Incomes are still very high. Unemployment's very low. Home equity is very high. We're not leveraging up as much as we were. So I just can't see what we've had a huge adjustment and no one panicked. Why would they panic now? Right? It's when we get this ridiculous blow off and everyone's like, well, this is how the world is now, I better just go leverage into something. I feel like it's got to be that sort of environment before the real big crash. So the 18-year cycle has definitely informed my view of it's provided me a sort of backdrop into a cautious little person over my shoulder saying, really, only 15 years since 2008. It's pretty fast. Have you noticed all these other things going on? So it's this little birdie on my shoulder saying, just remember, it seems a little bit too soon. Have a look at history, have a look at the cycles. Now, within that 18 years, there's plenty of variation, mid-cycle corrections, all those different elements. So maybe it's a substantial little correction in the price without affecting too much else in the economy. So that's my backdrop. I'm very acutely aware of these cycles, but I'm very flexible on, maybe it's accelerated this year. I'm not sticking to my 2026 it's got to be, or 2027. But it doesn't feel like we've had the complete cycle yet.
I think we get caught a little bit in the stylized ideal of the cycle, which is what Fred Harrison would have, when he originally did that kind of stylized diagram, that you've got this kind of 7 years up and then this bit of a dip and then this 7 years up and then a bit of an acceleration through the final 2 years of that second half, which is this winner's curse phase. And so everyone's thinking, oh yeah, you've got this gradual rise and then boom in the second at the end, and then of course the crash that comes after it. I think the difference now is that there's a lot of tinkering with policy. So, pouring stimulus into the economy, of course, is going to produce kind of like a winner's curse effect. You're going to have a pullback from that unless those conditions continue. It doesn't necessarily mean that you've reached the peak of the cycle, but like you say, it's just like because we had the same, sort of leading into 2017, this pullback in 2018, because of the way that the policies, occur in the housing market now. There's a lot more kind of volatility and a lot more sensitivity, particularly when there's a proportion of the market. Because in 2015, I think it was around 50% of the buying market were investors at that point. Of course,
it's
in and out, based on sentiment. So, I mean, you only have to have a little bit of nerves to kind of hit that demographic before they step out. And as soon as they step out of the market and you get that drop in buyer demand, of course, you're going to get that pullback. But the thing about the character of the 18-year cycle is that it was talking, obviously, it's noted on the stock market as well as to what happens in the stock market. But it's a real major recession at the end of that cycle, and it does have ingredients that I think are pretty that you've seen repeat throughout history, particularly over recent times, which is that, as we were saying earlier, that run of speculation at the end, and then that nobody sees it coming and nobody expects it coming, the massive fall, of course, which is very sudden. I mean, if you think back in 2008, I mean, the what happened through that period was unexpected and
yeah, you're totally right. I just think my only hesitation and caveat on a lot of this is it depends what the US Federal Reserve does. If they just keep hiking and hiking, I think they can generate enough panic to really have a sharp correction. The only thing worth keeping in mind there is that they can also undo all those interest rate rises in one meeting, right? Again, so yeah, I'll be interested. I'm definitely following closely what's happening in the US economy because it seems like they've had a quite sharp response in terms of home building, for example, to their interest rate rises. So I'm keeping an eye on that. But it's still not my sort of base case or most probable case that there'll be a 2023 huge correction and recession as a result of the property market. So yeah, that's what I'm thinking.
Well, we'll see how it plays out, over that. And I think the other thing perhaps worthy of mentioning before we wrap up is the difference between, Australia is a big country geographically. I mean, the difference between what's happening on the West Coast and what's happening on the East Coast, we have to take into account, because Perth, a completely different atmosphere in its housing market at the moment, compared to, what's been happening in Sydney in recent times. Perth and Adelaide, which are very affordable and I mean,
yeah, so Perth obviously had record affordability just until recently, right? Because prices were still not at their mining boom peaks nearly a decade later. So yeah, Perth, Darwin's also booming again. Yeah, it's worth keeping in mind that a lot of cities are out of sync and have other local factors that are quite important. So, for example, the influx of high-income mining and gas workers in Darwin and Perth, they're more tied to the mining cycle and the housing cycle in the rest of the country in a lot of ways. But fundamentally, I do still think that, as I said, that sort of baseline interest rate effect is still there. It's just that they're very out of sync and they're very cyclical and even more responsive to their local changes in income due to mining, etc. So yeah, that's the other thing about property. There's the national trend, and we can see a nice smooth curve when we average the whole country, but actually it's all happening at different parts to get that smooth curve. And I remember in the 2003, Sydney peaked and fell 10%, but Brisbane and Perth were rocketing. Brisbane shot up next, and Perth took until more like 2006-07 before prices moved at all. And Sydney prices had already come back more than 10% by then. So there's a little bit of that, geographic asynchronous trend. And that's worth keeping in mind. You don't want to take the average national trends we've been talking about and therefore not buy a house in Perth right now, for example, if you've been hanging out or you've found the perfect place. Because the national average is also heavily skewed to Sydney and Melbourne, which are combined 45% of the national index. So 45% of the houses and people are in Sydney and Melbourne alone. So it really is a Sydney and Melbourne index predominantly. So yes, keep that in mind. Totally agree with you, Catherine.
Yeah, and Darwin. I mean, a real interesting story in Darwin, because I think rents are approaching the peak, their 2014 peak. At the moment, prices are still lagging, but I mean, it's such a small market in Darwin that just a small move of that population needle can have a dramatic effect on the property prices through the demand there. And you're seeing that, of course, you see that first in the rental market. So I mean, I'm quite bullish about what's going to happen with Darwin this year. I know Louis Christopher he's kind of seeing price falls there, but I just honestly can't see that playing out particularly in the shorter term.
Yeah, I'm not sure. I think a lot of the regional areas depend on what's happening with resources. Queensland, Northern Territory, and WA. I think it really depends on the resources market in 2023 and whether there's a round of investment. As I said, I think they're more closely tied to resources than property markets in Sydney and Melbourne. So, but I'm not really sure what's going to go on there.
Yeah, well, we'll see through this year. But thanks so much, Cam. I'm so appreciative for you coming on and having a chat. And see how your forecasts play out. And your book, when's that? You're still writing it?
Yeah. So hopefully Christmas next year you'll be able to buy it. That's the plan. So that's my project, to get it finalized in the first half of next year and get it out for Christmas.
Yeah, okay. Keep us updated, because
perfect. I will. I'll be back when it's out for sure.
That's good. You will for sure. Yeah. All right. We'll talk soon.
Great to talk, Catherine. Bye.
Bye.